live on the webinar. Please make sure you've got a pen and paper ready. And welcome. We are live for this wonderful stock market update webinar. It's going to be high energy, lots of wonderful information that you want to know for your pensions and for returns. So top tip, make sure you've got a comfortable chair, glass of water, pen and paper, a camera phone to take photos of some of the most important slides I'm about to show you as well. And we are ready to go. I'm going to go through not just an update on the markets, what's in my pension, my son's junior ISA, SIP, etc., but also what the top performing hedge funds are holding at the moment. I will also share with you what I've selected from my spreadsheet of 10,000 stocks, which ticks the most important boxes in investing. So you're going to have all of that in this weekly stock market update. It is live. We're also on TikTok as well. So welcome one and all. As always, I will ask you, and Barry's already done this, so is Peter and Stefan. Let me know where you're from. Stefan's in Zurich at the moment. Peter is in Auckland, New Zealand. And Barry is in Pinner. So we've pretty much got the world covered between all of you. That's fantastic. More of you signing on now, so that's good. We've got a good number. We've got 3,901 registered for this webinar. Doesn't mean everybody will attend, but that's a pretty large number to have registered. So let's get on with it. I love this little logo. I've stolen it from elsewhere, to invest and serve. Now, what am I going to cover in this? Just for those of you who are settling in, just getting comfortable, and so on. I am going to cover the stock market as it is now, 12-month holdings, what I like the looks of. I will also cover some of the elite wealth management banks buy recommendations of the past week, and which I think meet my filter criteria for the next 12 months. I will also, in this webinar, cover a whole bunch of stocks held by hedge funds, which have generated 40% per annum for the last 3 years, and then look at the holdings they've got at the moment and see if any of those meet my criteria and can generate therefore 40% for the next 12 months. Okay, so that's what we're looking at. Pedigree, history, lots and lots of fundamentals as well, and trajectories. Right, so pens and paper at the ready. I've just come back from New York, where I was, amongst other things, working on this book, which is going to be published by the Financial Times at some point. Once I get around to it, it'll be my book number 19. The contents of this webinar are purely for education and information purposes only. They are not a solicitation to buy or sell any security, and they are not individual financial advice, because I'm not speaking to you individually. I'm speaking to you collectively. Okay, so hi, everybody who's on here. I just want to get an idea of how many of you think the FTSE will end 2024 higher than today's levels. Let me know in the comments, in chat, or on the poll. I'm also going to make sure everybody on this webinar gets a free copy of my book, Investing Unplugged. Okay, I'll make that available shortly. We've got reviews from Bernard Opperty, who is the founder of a $2 billion hedge fund, from Bloomberg TV, from Financial Times. It's a really good, important book on how to invest better. It was one of my earlier publications, courtesy of Palgrave Macmillan. Okay, you should all be able to hear me loud and clear as well, I expect, on here on TikTok. We've got quite a few of you on there as well, which is always good to see. Now, my approach to investing, as you are about to discover in the course of this webinar, is when I look at value, growth, income, cash flow, momentum, Sortino, alpha, in one sense, I'm being incredibly lazy, but I'm also being incredibly diligent. I'm following what probably the greatest fund manager in the history of the world said. He said, I have no opinions on any stocks. The computer has its opinions, and we slavishly follow them. His medallion fund earned $100 billion in trading profits between 1988 and 2018. He passed away, sadly, this year. Annualized returns of 39% after fees. Okay, 39% after fees. I didn't know about this quote until earlier this year, and that I was using the same principles, which is I don't have an opinion on stocks. The computer has an opinion, and I follow the computer. We go through 10,000 stocks listed on the London Stock Exchange, NASDAQ, New York Stock Exchange, foreign stocks listed in America, anything that can go in your SIP or ISA if you're in the UK, that is in there. Okay, I put all of that stuff in there and we take it from there. Okay, it's that simple. What I'm also going to do right now, because you wouldn't believe this actually happens, we get a massive spike up in people joining the webinar. For those who want to watch this live on their computer screen, it's alpeshpatel.com/shares for those of you who are on social media at the moment. What I'm going to do is also let my huge audience on Telegram know about that, that we're live now. Now, I also want to show you the valuations. What you see on screen there are valuations of those companies. Red means overvalued, green means undervalued. However, it is not that simple because valuation is not the only thing that moves stock prices. So just because something's overvalued in the sense that you are paying you're paying $28 for every future dollar of expected profit in Microsoft doesn't mean Microsoft won't move further ahead than, say, ExxonMobil, where you're paying $14.62 for every dollar of future profits. Okay? It doesn't work as simply as that. But it's showing you that the market is in many ways expensive. To some extent, valuations incorporate growth in them already. But guess what? The best performers have been some of the most overvalued companies, which is why we don't just look at value alone. We look at my holy grail, which is this bit, value, growth, income as well. All right. And what that does by looking at value, growth, income, cash flow, Sortino, none of these meet my criteria. Why? Because they're not green across these first 5 columns. All those first 5 columns have to be green based on Nobel Prize winning research from Daniel Kahneman, Eugene Fehmer, and Richard Thaler. If they don't meet that, they're not good enough. And the reason being, stocks do not move up based on value alone. They move up based on valuation, growth, and value is more important than growth. Growth is more important than income. But anyway, I wanted to share the valuations with you over there. So where does that leave us before we jump into those stocks? Well, first of all, in the next 7 days, these companies have got earnings. Which of these are going to move the markets? Well, after market close, that means today, Tesla, that could move the market. I don't think Coca-Cola or T-Mobile's earnings will. Keep an eye out for ServiceNow and NextEra Energy. These are ones which, and Thermo Fisher, these are ones which have come up before on our lists of purchases. GE, Vernova, spin out from GE, Lam Research have been on there in the past, General Dynamics, but none of these are likely to move the markets. And similarly, whilst I'm showing you when these earnings are coming, none of these are likely in and of themselves to move the markets. Excuse me while somebody decides to make a phone call at this time. Okay, so that's where we are with all of those. And ResMed has been one that we've had before as well. So keep an eye on those, but none of those are going to move the markets other than possibly Tesla, right? They could move their own movements, of course, their own share prices. On Friday till next Wednesday, here are the big ones. I'll mention some of the ones which have been on our lists in the past, but are unlikely to move the markets. Now, Alphabet is coming out on Tuesday with earnings. That could move the markets. Visa, probably not. And I'll circle the other ones which we've mentioned in the past. Obviously, Microsoft and Meta both come out after market close on next Wednesday. Eli Lilly, AbbVie won't probably move the markets, but Booking has been on our list in the past as well. So it is earnings season, all right? So keep an eye on that, and I will do more commentaries, and I'll do more market updates on those. Don't forget to do all of this. So why do I look to tick all these boxes? For those who are new to my webinars, before we go into individual stocks, what I like, how the market's moving, and all of these things, what do I do? Why do I like to, or why do I think it absolutely essential to go through all of these factors? And the reason is, if you leave out an important piece of information like the value of a company, or if it's growing, or its income that it's producing, or its cash flows, or its momentum, which is that bit, or it's Sortino, that it's consistently on average had very good performance with very little downside. After all, don't you want a stock which goes up like this with very few falls, and if the falls happen, they're very shallow and they recover quickly? Well, that's what Sortino measures. But a long only fund manager, let alone IFA, and IFA will go, huh? What's that then? An alpha, which is outperformance of the market. So if the market goes like this, your stock goes like this. Okay, wouldn't you want those all to be green? Of course you would, but there's academic research to show that those things are better at moving markets. They're not guaranteed. Just because it's all green doesn't mean you're guaranteed a return. If you could do that, you'd pick one stock and you'd all be around in private jets, wouldn't you? It's not guaranteed, but it's still a pretty bloody good indicator of what's going to happen. I'm going to tell you something on the poll. 46% of you think the FTSE will be higher by the end of 2024. 46% of you. The rest of you are either not sure or you say no. Let's do the same poll with the Dow and see what you all think, whether from now till the end of the year it'll be high, and put it into the comments box as well if you so wish. Okay, those of you watching on TikTok, you might want to join alpeshpatel.com/latest shares to join the webinar on your computer screens. alpeshpatel.com/latest shares to join this live on the screen. So moving forward, what about the past week? How's it been? Well, it hasn't been a classic week. Actually, it hasn't been that great. You've had a few greens like Netflix, and I'll come to that in a second. Some of the big tech is really, I mean, I guess you can't complain about Microsoft and Nvidia and Apple, but generally most people have taken money off the table this earnings season for a variety of reasons. We're not trading, we're investing here, so I'm not too worried about these short-term movements. There's an important lesson for you to know as well. Okay. Now, what about the past year? Well, this is exactly why I do what I do. My job is to make people add profits to their pensions, and it becomes a hell of a lot easier when you've had over the last 12 months returns like this in the market. You could basically throw a dartboard at that screen and smash the screen, but you might hit basically everything that's green. It'd be pretty bloody difficult not to, because there's so much green there. Imagine you played that as a game, what it would mean. Okay, so you might hit a green of Microsoft and Apple and Alphabet and Meta and Amazon and Nvidia, all of the ones which we have. And then what would happen is you'd have your 30% return on Microsoft, 35 on Apple, Alphabet 20, 84 on Meta, 48 on Amazon, 225 on Nvidia, and a few other smatterings around here, and that's your job done, and your pension had a great year. And if every single year afterwards is just mediocre, it won't matter, because you've suddenly moved from I don't know, a £500,000 pension to a £750,000 pension, for argument's sake, in the space of 1 year. And then the rest of the year, you're just growing and compounding all the rest of your life at that. But hopefully you'll have a few more years like this. I can't control the market. I can't make the market do these things. But all I can do is make sure I'm in a position to profit when the market does that, when it moves. Okay? And that's my job. It is that simple. I didn't invent Apple. If I was clever, I would have done. I didn't. All I do is ride the coattails, which is why in my home of Yorkshire, I'm probably hated, isn't it? Get a proper job, you London spiv, because you're riding the coattails of people who work in those companies, who invented those companies, who own the intellectual property. Well, so be it. That's how life is. So be it. But at least my pension's doing really well. It doesn't have to be a pension. It could just be your children's inheritance. Is that easy to do? Well, I'm going to show you it's easy to do. And the way I did it, what I'm going to share with you, we first started off with the hedge fund in 2004 and then thought, well, wait a minute, why don't we make this available to retail clients? I mean, it's not as if they're going to shut our fund down just because they've got access to data. It's not like the code to Coca-Cola or KFC's secret recipe of herbs and spices. And we said, well, what we want to do, and fund managers still don't do this, is we want to tick the value, growth, income, cash flow. Croaky comes from Goldman Sachs Wealth Management. I stole their intellectual property there, rode their coattails. So I'll explain that in a moment. Momentum from the hedge fund industry, Sortino and Alpha, to get those returns. Okay? Now, I didn't get those returns. The market did. And in other years, it's not been as good because the market didn't rise as much. By the way, exchange traded funds, we'll look at those stocks specifically in a second and what I like at the moment. Remember, this is an investment webinar, so it's going to be 12-month holdings. It is not for trading. That's not what we're here for. ETFs, I'll do a separate webinar on. So where are we year to date with the market? Well, this is where we are, and it's pretty bloody attractive. The S&P is up 22%. The Standard & Poor's, which measures 500 of the largest US companies, is up 22%. NASDAQ up 20%. The Dow 13. Now, for those of you new to investing, this might sound complicated. 22%, I think you can all understand. When I give you a free copy of my book, Investing Unplugged, you will see, and I'll put a link up, you will see that, well, actually, if you're on TikTok, go to alpeshpatel.com/latest shares. For the rest of you, I'll put the link up in just a second for the files, so you can download the book. But the point is, and I explain how investing can be simplified, is that is massive. And if your pension did that, you're laughing. Of course, it doesn't just go up in a straight line. Look at those periods of declines. Look at those periods of sideways moves. That happens. That's why we say 12 months and not 1 month holdings. That's why we're investing, not trading. It's not to say trading can't be lucrative. It's a different webinar, though. Okay, where are we in terms of the sectors which have done incredibly well? Those are the names of the sectors. Year to date, from January, I did not gamble on a specific sector, not least because look at how those horses in a horse race have moved. They're all over the shop. However, I don't care what sectors are doing well and which ones aren't. What I care about is the underlying companies and if they're good quality. Because yes, sure, if there's a good quality company in utilities, it will have done really well. But even if there's a good quality company in energy, it should do well. So I'm not gambling on sectors. Instead, I want to tick all the boxes. You can see here the factors which have led to the biggest stock rises this year to date, and it is momentum, value, and growth. Momentum, value, and growth. Those are the factors. So I want stocks which tick the momentum box, as you saw from my Excel spreadsheet, have growth, and are undervalued. That subset of a subset of a subset. Remember your Venn diagrams from school? That's what I want. The way to get it, it's very simple. I make this available to my clients, and I'm going to share some of the results of this and make sure we have got a green on value growth income. If you don't have value growth income, you don't actually have a good system, because it means you're not looking at all the relevant information. If you're not looking at all the relevant information, you're gambling. It's just, that's how life is. If you don't look at all the relevant information in anything in life, you're gambling. From which restaurant to go to who to marry. If you don't look at all the relevant information, you are gambling. The less information you look at that's relevant, the more you're gambling. Simple as that. It's like crossing the road with your eyes closed. Then you're gambling. You might still get across the road, but bloody hell, you were lucky. And you might mistake luck for skill, which people often do. And then you really are in trouble. So why are we looking at all those numbers? I'm going to show you to get to this. Because the returns are worth it. Because in years like this, where the NASDAQ's up 39%, if nothing else, we should be around that figure, if not substantially better. We should be, for our savings, our investments, our pensions, in the years where the market has given us that. There's no guarantee the market will do that. But out of every 7 years, about 4 or 5 it does. 1 or 2 years it falls. The rest of the time, it's sort of sideways. So, yeah, it tends to keep doing it. Whilst there's no guarantee, it comes to do it. And we want to be in a position to take advantage of that, because those are numbers worth bloody well taking advantage of. If you had $1 million in your pension and you suddenly made 400 grand in a year by just having something like that, and you were lucky enough to be on the ball and take advantage of the market because you did the homework beforehand that, yeah, actually, I want to know, how do I do this? Then you're up 400 bloody grand in a year, and your pension is now 1.4 million. The NASDAQ was up 40. Well, it's so far over the past year up 40%, 39. Okay, so is the S&P, right? That is important. There's no guarantee it'll happen again, but if it does, I'll be in a position to take advantage of it. That's why we're here, because it's worth getting 40% in our pensions or investments and savings. The younger you are, the even better it is for you. Right, let's look at the markets. Let's go through all of that and stuff, and this is where we are with it. FTSE 350 over the past month, these are the ones which have moved the most. So be it. Let's look at the S&P 500 more importantly. And we are here. Okay, that is a measure of momentum. What this is, it's a measure of short and longer term average prices that the S&P has been producing. And generally, as a rule, when it's at this level up here, it could well fall. Okay, it could well. It's not guaranteed to, and it hasn't happened yet. So at the moment, I'm happy with the investments that I've got. That's the seasonality over the last 10 years. I'm happy with the investments I've got. So would I buy more S&P? Well, I'd be very cautious to do so. So I continue holding the S&P 3 times leverage that I have since last January because it's doing rather well. Would I buy more? Probably not at this level. Would I hold? Well, yes, I'm doing because I don't have an exit. I'd only exit if this scenario happened, what I call a daddy bear, the MACD falls below its moving average. Is the only point at which I'd sell, so I continue holding this. Very simple. NASDAQ, same story. Exactly the same. Have a look at it there. Exactly the same story as the S&P. Really simple. Okay, not rocket science, not complicated. Okay, but wait a minute, Alpesh. When would you sell again? If that scenario happens, see that pattern? That pattern has been a pretty good way. It's not guaranteed to, but a pretty good way of knowing when to exit. Okay? Generally, as a rule, good point to exit. Entry usually when the MACD is flat to rising. Very popular today, I am. When it's flat to rising. Okay? That's usually the best point to enter, especially if this is. Now, we're not at any of those scenarios. We're at this scenario. So I continue holding my NASDAQ leveraged exchange traded funds. FTSE, I don't hold any in the index, and it seems to be going sideways for the moment. We'll see. They're probably waiting for the budget. What I'm essentially trying to do is capitalize on this. What is this? Well, the average positive return is 32% in the S&P over a 2-year period. A rolling 2-year period. So yes, you got your top. And people ask me, what's your average, annual average? They're so stupid. What do they care about the average? For the simple reason you've got variance in the average. So you might get a year like this where the NASDAQ's up 40%, or last year it was up 55%. So we have a blowout year. But what about 2022, where we had to hold cash most of the year and we had next to zero return? So you go from 0 to say 80% return. What does the average matter? It's not a bank account. What matters is it guaranteed? No. What are you going to do if you get 2022? Well, if it's a down year, you just look at for a daddy bear. Is the momentum, the average price is short and medium term falling as shown by the MACD, in which case you hold cash. Simple. What about a good year? Well, it's out of your hands. It's for the market to give. And we know that the average positive return is 32% over a 2-year rolling period. And positive returns happen 88.5% of the time. So, Alpesh, you're not good because you're clever. You're good because because the market's good. Yep, that's right. What I'm actually focused on is not the upside. The upside takes care of itself. It's out of my hands. It's down to Apple, Amazon, Costco, Coca-Cola, whatever else, Nvidia. I'm trying to avoid 2022s and being in the market then. Your fund manager can't do that. Fund managers cannot avoid bad years. Always ask an IFA or a fund manager, what did you do in 2022? And they'll never say, we held cash. Because they're not allowed to. What they will say is, oh, but you got to ignore that. We know we lost you 6 years of returns in 1 year, and I'm going to show you this. And this is what kills people. Okay, a few simple truths is what normally kills people. And Warren Buffett says this as well. It's just the ignorance of people who've been fed stuff that they read somewhere, which is just simply not true. So let me actually show you what in actual fact happens, okay, when you get a fall in the market, like in 2022. Okay. Your fund manager and your wealth manager will never, ever, ever, ever tell you the truth on this. They'll give you all sorts of bullshit instead. This is Meta. Okay, let's go to Meta from That's It Today. Now, year after year, it went up and all the fund managers said, let's get our marketing done because, we're really clever. We bought Meta. No, it's the most well-known bloody company in the world, you muppets. So they kept talking about how good they were. Then when it fell in 2022, all they could do was say, oh no, you got to hold on, because it wasn't the only one to fall. Pretty much everything did. You had to hold cash. Holding stocks would have lost you money anyway, right? Now, how do we know to exit? Well, I told you, daddy bear. If the short-term and long-term average prices are both falling, so the average price in the market in the short and long term is both falling, shown by that dotted blue line crossing below the yellow one, then you bloody well hold cash. Now, I didn't know it would take the whole month to hold cash. I didn't know Meta was going to fall 73%. I don't try and over forecast things I don't need to forecast. Okay, very simple. And when that fall stopped happening, there we could get back in, which we did in January 2023. So we had 178% return over 2 years. What did you have? Well, for your IFA, you would have had a 0% return. Why? Because he would have said, oh, no, just hold on. Don't worry. The fund manager went to Eton and the right universities as well after that. So it's all okay. No, they're bloody idiots. Okay. That's why they're working as a fund manager. Now, there you go. 0%. And they said, see, it always comes back. Well, no, you lost 6 years of your pension in 1 year. Could you take a 78% drop? This is the point at which, when it's falling, you're having a heart attack. This is the point at which your wife files for divorce. This is the point at which, or husband, don't have a husband, but your spouse files for divorce. This is the point at which they're granted it by the judge because you're an idiot. And then that rise you missed anyway. And the fund manager goes, well, I got 0% over 2 years. You say, well, you missed out on 170 odd percent, maybe even 100% over 2 years. Okay. And that's what your typical fund manager does. Why can they not hold cash? Why can't they go into something else? They can't hold cash because the regulations prohibit them charging you money for holding cash. The IFA will never tell you, don't pay me fees, just hold cash this year, mate, because they want to earn fees, conflict of interest. All right. And thirdly, they can't find another stock because there were hardly any which bloody went up that year. You can't make up companies which don't exist, can you? Right? So very simple. So my job is to make sure in those years, 1 in 7 years we have to hold cash, we avoid the worst returns of negatives. The average negative return anyway is minus 18%, but I don't even want that. I want to avoid those 45s by going to zeros if we can and making that smaller. Okay? And it works. This came from Trevor Atkin. I've revealed his full name as well. And he's just done the free stuff. The stuff you're watching on Telegram. In 12 months, I've seen a 30% increase. Well, you could say it's thanks to me. It's also because I've provided that knowledge so he can do it himself. He can do it himself. Okay, he's watched these webinars and videos, and he learned. Now, if had the market just never risen ever again, then none of us will be happy. But hopefully that won't happen. And it's easy because it's easy to open a SIP or ISA or 401k or wherever you are. And by the way, this is not an advert from Barclays. You could do it with whoever. Because you just go online and they make it really easy to open an account, fund it, and then decide that you want to buy, I don't know, £1,000 of Costco shares or Walmart or whatever. And we'll look at the stocks in a second. It really is that simple. And there's lots of brokers. I'm not endorsing any of these, and you'd want to check all their fees, especially exchange rates. If you're going to buy foreign stocks, which I do, all my holdings tend to be US stocks anyway, or indices. But you probably want to know, well, wait a minute, how long am I going to hold these for, Alpesh? It's all very well saying that you buy these. You said 12 months, but how do I know what to hold for how long? And I'm going to come to that in a second. How do you know what to hold and how much you should have in funds? Now, I'm not saying you would, but of course, you could look at a Bill Gates or Warren Buffett portfolio. Don't do that because they've bought these at different times for different reasons and they've got different outcomes and goals. That's their portfolios. But what's interesting is after the first 5 holdings, they have less than 5% of their money in anything else. In other words, they're very, very concentrated in where their wealth goes. I tend to have 20 stocks for 12 months. And you can see why, because after 20, you're not really diversifying much. Okay, you're not removing any more company-specific risk. So 5% capital in each, roughly. Okay, this is from Goldman Sachs Wealth Management. Now, I think I've got 25 years to retirement. Therefore, I will have 10% in fixed income or cash, where I get about 4.5%, and instant access, and the rest in stocks. But I could easily have put some in funds and been a bit more conservative in that regard. And where would I have found those funds? Well, there's about 6,000 odd funds. And again, we want momentum and volatility, Sortino Alpha, all to be green. If it's not all green, then we don't want to be holding those. 12 months. Okay. Now you got your answers. Simple. That is so simple. I can teach somebody that in the same time. actually in a far shorter time than I can teach them to drive. I can teach them all of that in 1 hour, all in 1 hour. Give me 1 hour and I'll explain all those bits on the Excel and everything else. Why is this so important? I'm going to go to the individual stocks in a second. Why is this all so incredibly important? The reason it's all important is headlines like this. Has your pension lost a fifth of its value this year? Okay. We reveal the lottery of returns on work retirement plans. This is from the Daily Mail, right? That was from 2022. These things haven't changed. Also 2022, anger grows Mercer's awful treatment of pension savers. So if your pension's with Marks and Spencer's, Morrison's, Whitbread, Scottish Power, or any of the big companies, just be careful, because the newspapers are talking about just how badly they're treated. In fact, to the extent the Financial Times has said, give workers power to ditch pension schemes, right? They really ought to be doing it themselves, because you see the difference. Or The Guardian. The Guardian. So we're not just talking right-wing newspapers. Pensions, why do those retiring face massive losses despite FTSE highs? Retired planner was shocked to see his Aviva pension had dropped 20% in 1 year. Oh, but Alpesh, if I give it to an expert, forget the growth, they will make sure things don't fall. Yep. No, they won't. Because they have to keep the money invested, unlike you. So you're screwed. That's The Guardian, for God's sake. It's not exactly the epitome of capitalism, is it? And that's why I'm on a mission to teach people. This is part of my program. You don't have to be male or wear a dinner suit. That's my inn, Lincoln's Inn, of which I'm a member, and we had dinner there. And we get more and more members joining up, which is great. Okay, it's me at Bloomberg. I was in New York recently. I didn't get a chance to do Bloomberg this time, but I did last time I was in New York. I used to do a show on Bloomberg each week, and I've written 200 columns in the Financial Times, always talking about this. Always talking about exactly what I've just told you, right? Now, I'm going to go through some of the stocks for the market update and also for the new things that I've launched. And I'm going to dip into some of them. We look for exchange-traded funds or funds, baskets of stocks, which have a realistic prospect of a 40% return in a year. In a year, realistic prospect based upon the existing trends and momentum and growth and Sortino and Alpha. Hedge funds, I'm going to show you some in a second. Which hedge funds are generating 40% per annum for at least the last 3 years, have billions under management, what are their picks, and which of those picks is likely to generate 40% in the next 12 months with a very tight stop loss. 12-month holdings is not trading. Wealth management, bank stock buy. So which of the biggest banks are giving a buy recommendation this past week, which are likely to generate a 40% return over the next 12 months? Based on not just the bank's analysis, which might be a Goldman Sachs Wealth Management or whatever, but also based upon value, growth, income, all my filters as well. And on top of that, momentum, intermediate term as well. Well, I'm not going to go into all of these right now. This is what these ones are for. These are for people who want slightly shorter term, maybe hold things for 3 to 5 months. I'm going to show you some in a second. Exchange traded funds are more for people who want a far easier, quicker way because they want funds. And again, we need that 40%, but the volatility has to be minimal in all of this. If it's not minimal, I'm not going to do it. Okay. And with special situation, these are the hedge fund ones. So I'll show you this in a second. In fact, let me just show you one or two of the hedge fund ones at the moment. What we're looking at for the hedge fund special situations is they've got to meet this criteria. The hedge fund must have returned 40% per annum over the last 3 years, billion under management at least, must have had at least 5% of its funds in the stock I'm going to look at. A 40% return has to be reasonable projection for 12 months based on the trend of the stock. Usual GRED investments program exit rules apply. In other words, 25% from entry to keep it simple. Meet my GRED investments program special situation minimum criteria. In other words, value growth income of 7, 8, 9, or 10. That's incredibly important. If it doesn't do that, it's pointless. And a rising MACD, i.e. monthly, from an oversold position. So if you take a hedge fund like this with 1.4 billion under management, which has generated 53% per annum for the last 3 years, what does it hold? It holds all of these, but they're not good enough to buy because you might be getting in just before they're about to sell them. Okay, so what we then do is go through and see, do any of them meet my criteria? Or take this one, 53. And by the way, in the case of the last one, none of them did. None of them did. So fine, let's go to the next one. 4.5 billion, 53% per annum for the last 3 years. They own all of these. Do any of these meet my criteria? If they don't, too risky, won't do it. Okay, none of them did. David Glasson, 1.1 billion, 50%. Do any of these meet it? Well, look, I'll tell you already. You know I happen to already own these, but would I buy them today? Well, I'm going to come to that in a second. You know I already own this, but would I buy it today? That's the difference. Just because it came from a hedge fund and they own it now doesn't mean anything unless our data shows, would I buy it today? So you already know I own these two. Would I buy it today? And I'm going to share that with you in a second, whether I'd buy it today. And these are multi-billion-dollar hedge funds over 40 to 50% per annum. Now, just because they're generating all that, I don't particularly care. What I care about is, does it also filter through and meet my criteria? Okay, that's what I care about, because otherwise my wife will kill me if I mess it up. Right? And with the banks, it's these. Let me show you with the banks what we're looking at. We go through all the banks and all the major banks, brand names, and have any of them given us a buy recommendation of any stocks in the last week. At least a 40% reasonable target in 12 months. Exit will be specified in the video. Multiple reward to risk. In other words, 60, 70, 80% to the upside and just a 20% stop loss at the bottom. Again, we'll look at if they meet my criteria, and if they don't, then I'll make that clear and say, look, ServiceNow, that's the direction, but the stop loss has to be at least half of the projected gain. So we've got a multiple upside to downside. Doesn't mean it's going to happen. That was a buy recommendation over the past week by Citigroup, but that doesn't mean it's going to go up. We still need to make sure value, growth, income, etc., multiple upside to downside. So it's not just, oh, the bank said it, but how do you know the bank is ever accurate? They're not. We're just using that as an entry filter. The most important thing is we then input that into this, into the individual stocks that I have. We put it into here and say, well, wait a minute, does it meet these criteria? That's what's important. Let me say that again for the slow of hearing. What's important is, does it meet these criteria as well? Okay? It still doesn't guarantee you're going to become a owner of a private jet, but certainly puts the odds further in your favor, I would have thought. And we want to avoid making problems like this idiot. Apologize. Poor investment. UK fund manager blames lack of exposure to tech. No kidding, you muppet. And fossil fuel stocks as broader malaise in UK market. So basically, he blamed the tools. No, it's not actually Nick's fault. He's not actually an idiot. He's just conflicted. He's been told by his employer, you can only pick UK companies. So obviously he's performed poorly because he's got no tech companies to invest in. All right. And so he said, oh, God, look. But he gets paid by his employer to keep his mouth shut and not say, listen, guys, you shouldn't actually be putting your money in my fund. You should be managing it yourself, putting it into tech companies, for instance, or whatever else. But he can't say that because he's getting paid to shut his mouth. He's not stupid. He's not exactly about to go, no, guys, He will soon resign because nobody needs that kind of bad brand exposure and set up his own fund, obviously. Now, this is the problem, what I'm talking about with fund managers, IFAs, and wealth managers. And I guarantee you your St. James's Place fund manager, IFA, wealth manager is going to say exactly this piece of nonsense. And Scottish Mortgage Investment Trusts are a classic example of it. When they lose 50% of your pension value, what they will say is, yeah, but I tell you the worst bit of nonsense I just heard. Somebody from St. James's Place said, nah, you should really buy shit funds because, and this is their reasoning, and I wrote about this in the Financial Times, but this is how stupid these people are. He said, because the really good funds, 3 years later, don't perform well. Yes, they don't. You should never buy today's good fund because you're absolutely right. 3 years later, they tend to revert to mean. So what St. James's Place proved is that good quality funds don't persist in their performance. It's well known. Academics have pointed this out for years, that there isn't a persistence of performance in funds in the top. In other words, don't go with well-performing funds because they tend to revert to mean, which is another way of saying, and Eugene Fama got the Nobel Prize in economics for proving this, they're lucky if they ever end up at the top. If you throw enough heads, you'll get somebody. If you've got a large enough group an audience, you'll get somebody who throws 10 heads in a row, for instance, right? But they then jump to this piece of illogical logic. Therefore, you should go for shit funds like St. James's Place, because surely they'll also might do better. Can you imagine? Well, actually, guess what? Somebody's done a bit of research on that as well. And they don't. Sadly, poor performing funds don't revert to a higher mean. In other words, if you're an amazing basketball player, sooner or later, you will basically not get top goal or whatever baskets in every single game. You will fall back a little bit to your long-term average. But if you're shit like me at basketball, you won't suddenly get better. You'll remain crap, okay? Because you just are. But they did that marketing twist. I can't believe, and they sent this across to someone. So just be warned. They will say all sorts of rubbish to tell you to invest and justify a 50% drop. I hear it from IFAs all the time. I showed them this and they said on Twitter, yeah, but you know, we've got kids in private school. It's our right to charge people this. If they're so stupid, they should give us their money. And no, they didn't say that. They were saying that between the lines. They were trying to justify that. So like I said, whilst we look at what hedge funds are doing, that's just aside. What we're really looking at is this. The hedge fund picks are just a subset of that, or Goldman Sachs wealth management selections are just a subset of that, but they still have to meet these criteria. That's the important thing. It's just that people find it interesting that if what's in our box is also in some of the biggest funds, and they go, oh, okay, that's interesting. Okay. What we're after is this 600% return. That is the NASDAQ. That is the Dow. That is the S&P, which is up 300%. What we're trying to avoid is the FTSE, which is what most people's pensions have done over the last 15 years, which is up just 47% in 15 years. 47% in 15 years, okay? It's up by a half. Whereas your American cousins are rich because even if they're just tracking the S&P or the NASDAQ, they're up. They've tripled, quadrupled, quintupled their pensions. You haven't. It's not because they're cleverer than you. Genetically, it's been proven Americans are not cleverer than British people. It is because you went with St. James's Place. Well, maybe Americans didn't, and so they are in some perverse way cleverer. 58% of you think the Dow will end up higher than today's levels. Okay, I'm now going to ask you who you think is going to win the US general election. Now, I've written Biden for those who are on the webinar. If you're not on the webinar and you're on TikTok, go to alpeshpatel.com/latest shares. I've written Biden, but I mean by that Kamala Harris, because I did that poll. It's been on there since a long time. Can ETFs ever go bust? Is your investment safe with them? I've never known one to go bust, not even the really risky triple leverage ones. So if they're from a good issuer, they shouldn't. Hi, Joseph. We met when I was in New York. Wonderful to have you on, my friend, as well. Okay. So that's what we're after on the index. What I'm really after, I'll let you into a little secret. See that? This is how long it takes to double your money. 17 years if you grow at 4%, which is what your average St. James's Place IFA wealth manager wants you to do, right? They want you to be happy with that BS because guess what? The longer it takes you to make any decent return, the longer you've got to stay with them because you've not made a decent return, and the longer they're guaranteed that their kids can continue going to private school and all the rest of it. Right? It is a scam, and they're conflicted, and they don't tell you they're conflicted, which is really embarrassing. Now, if you did what the S&P has done over the last 10 years, you'd double your money in 5 years. You might say it's not worth making the extra effort to double it in 3.8 years. Yeah, fine, okay. But that's a big difference in doubling your money between 17 years and 5 years. Americans would look to do it in that time. British people look to do it here. Britain's getting poorer and poorer, and the rich, Americans, are getting richer and richer, just simply because the fund managers they think about in each country. Well, there's nothing stopping British people investing in American companies. Okay, it's that simple. In fact, look at that handsome young man at the age of 29 writing this in the Financial Times, where he wrote, guess what? I'm selling all my UK holdings and buying US ones. Okay. Now, let's have a look and dive deeper into what is in my son's junior ISA and SIP and my wife's SIP and my pension as well. Let's look at also the top 10 S&P 500 stocks. Okay, the top 10 S&P 500 stocks. Just going to check on. I think next time I might do a live on YouTube. I'm getting a lot of viewers on YouTube, and I think I might do the live bit on YouTube. Let me know you can hear me all quite clearly as well. Okay, so these have gone up in the past month. These are the biggest movers of the past month. Let's have a look at them, see if any of them are interesting. All right. United Continental Holding, it is a 9 on our value growth income. However, it's a bit overbought. So whilst all these banks love it, and in October, all of them said buy, a little bit overbought. I might be able to get even better stocks than that. Okay. Win Resorts can't be in my program because it's not 7, 8, or 9. So not for me. And the momentum, yeah, there's some upside, but it's probably just going to go sideways. So not for me. I know it's had a great month, but not for me. NVIDIA, you will know I already hold. It's an 8 for us. I know it's a bit overbought, but it's one of our quality 5 plus. The plus bit is NVIDIA, Novo Nordisk, Eli Lilly. And I'll talk about those in a second anyway. They're ones we perennially keep an eye on for good returns. And the 5 are the 2 A's and the 3 M's, Apple, Amazon, Alphabet. Apple, Amazon, Alphabet, Meta, and Microsoft. Okay. So at the moment, I'm not looking to sell this. I continue holding it. Would I buy more? Well, it's a bit overbought, so I wouldn't buy more personally at the moment. What if I didn't own it already? Would I buy it? I probably would because it's quality 5 plus and it's an 8. Okay. Las Vegas Sands, not one for me because it's not 7, 8, or 9. There's your direction if you get the most bullish upward trajectory that you have had in the past, but you'd really need this to move more upwards. So I wouldn't do it yet. And you probably want to put a stop loss. I mean, this is really volatile. So you got 64% to the upside. You probably want to put a stop loss there. Which means you've got a lot of downside, which means your position size has to be small. So when it falls that much, you don't lose too much money. So basically not worth the risk. Better off going to the Las Vegas Sands Casino. Micron, not a 7, 8, 9, or 10. I know it's had a good month, one of the best months, one of the best stocks, but that's falling. So not good for me. Wouldn't do it. Generac was a great one for us during that period. It was one of our best picks, as you'll see a little bit later. But since then, because we only hold for 12 months, since then, it's not been in our books at all. Now, at the moment, would it go back in? Well, it's not 7, 8, 9, or 10, but that momentum's rising nicely. Were it to continue along that trend, maybe that's over-optimistic that my data team has put it. So what happens is I have a data team and a graphics team. The data team pitch these things to me, and I then narrow them down. A bit like Billions. They walk in, I'm sat there like axe, and I go, yep, are you kidding me? No, I don't like that. What? You got the numbers wrong on that or whatever. So I think that's a bit too high on the projections. You'd probably have to put the stop loss there. So your risk over 12 months is limited because it's 166 to a stop of, what is that? 120. And that means that's 40 over 160, which, 30 odd % stop loss isn't too bad, given that you'd have a multiple upside to downside. However, it's not part of my great investments for him because it's not 7, 8, 9, or 10, but that's the thinking I wanted to share with you. Similar analysis with this, it'd have to do all of that. So whilst they all like it, that's fine for them, and that's the direction of travel. I think your stop would end up being what? At least that. That'd be too far. What's the point? Okay, so not one for me. That is a 7, but overbought. So if you really still wanted to do it, you'd probably put a stop there. You get your 91% to that side, and you've got something of a break there. Barclays said buy on that yesterday. JP Morgan said buy on 16th September. Whilst it's a 7, 8, 9, or 10, bit overbought, so wouldn't be a special situation in my program. It'd have to be non-special. 9 on the Delta Airline stuff, overbought. So again, if you really wanted it to be up there, but your stop would end up having to be here, which gives you some protection downside. Bank of America this month and Barclays and JP Morgan all said buy on it. That's up to them. But there's your upside to your downside risk, and you'd make sure if the downside was hit, you didn't lose more money than you were happy to. It's not one for me. Simple reason, MACD's up there, and whilst it's a 7, 8, 9, it couldn't be a special situation. I only do special situations in the program. Vistra Energy, in other words, I got better options than that one. Vistra is in that direction, overbought, not 7, 8, or 9. I know it's a nice, lovely trend. If you want to do it, entirely up to you. UBS and Bank of America would agree with you. Costco is one that I will return to in the future because it does tend to be so good. Just consistent riser. But at the moment, a bit overbought, and I've got better options. I'd rather return to this in the future, and it's not 7, 8, or 9, and it's overbought there. But it is one in my pocket, which I'll keep an eye on for my clients as well. Bank of America, we've been following this for ages. I can't buy everything, but that's what I see going forward. I'm not going to buy it at the moment because I've got enough other things in my portfolio anyway, but it's doing well. Netflix, as you also know, you've been following me for ages. We picked on this ages ago after it had these stellar returns here. And I said I wasn't going to buy it, but I'll keep following it because it's a good name. And it's continued to go up. And some people say, oh, don't you regret not buying it? I said, well, I can't buy everything. There's loads that I don't buy. But there you go. It's had a fantastic return for all of you who did follow. It's gone from 400 to pretty much 800. So you pretty much doubled your money in less than a year. Congratulations to you. And at the moment, would I buy it? No, because I got enough things that I own and it's a bit overbought, which is fine. Would I hold it if I owned it? Yes, because it's not dropped. And would I sell it? No, because I don't have a reason to sell at the moment. Walmart's a 7, a bit overbought, so you'd have to do it as a non-special situation, which means you'd probably end up putting a bespoke stop loss there. You got your upside on the basis of it going up, but it doesn't fit into the Great Investments Program special situation because although it's a 7, it's overbought. Okay, I'm not going to go into all of these. Berkshire, Eli, come on. I'll do that. I might come back to it at the end. Okay. Apple, I continue holding. Amazon, I continue holding. Microsoft, well, my views on that, I'll do on the private channel for the Great Investments Program. Same with Meta. If you're on the program, you already know what my views on Meta are at the moment. It's one of my quality 5, but you'll know my views. Don't forget, I'm on LinkedIn. I've got a lot more to go yet. Don't forget the campaign for 1 million to teach 1 million people how to be better investors. Okay. I want to make sure that I've covered all of those things. Now, there's a lot more I want to talk about. One of the things, like I said, the 25-year pension pain, for those of you watching on here, whether you're watching on TikTok or YouTube or on the webinar on alpeshpatel.com / latest shares. This was in 1999 when I wrote in my column in the Financial Times, I'm selling my UK holdings and only buying US ones. Eventually then, exactly 25 years later, the Financial Times ran a story, UK pension funds allocation to British stocks hit historic low. 25 years it took them of screwing you over, of destroying your pension. 25 years, because the amount of conflict of interest is unbelievable. Okay, because they're conflicted from telling you, hey, you should just do what has been stated here, because they don't get paid for telling you that. So you get Muppets like Blue Whale in your pension, down 27% in 2022. Always ask your wealth manager and pension fund manager, what happened in 2022? And they'll always say, oh, it was just 1 year and we made it back. Well, I just showed you with Meta. Yeah, you can make it back, and look at how much you bloody lost, you Muppets. Tell the fund manager that. Look at how much you lost. Yeah, we'll make it back. It was only 1 year. Yeah, you made nothing. You lost 6 years of a bloody pension. You lost 6 years of somebody's pension, more. 2022, all the way back. You took them back to 2015. Yeah, sorry, 7 years. And actually, it's 2023. So 7, 8 years of somebody's pension destroyed in 1 bloody year. And they'll keep making excuses. And the moment they do, just tell them, how many kids have you got in private school? Just ask them that. How many kids you got in private school? Because they're using your money. You're paying. You're working to pay their fees to put their kids through private school. I have nothing against private schools. I went to a state school and a private school. I went to both. What I have a problem with is doing it off conflict of interest and not telling somebody that they can do it themselves far better. And it's not just been 2022 or 2023 or 2024. This is 2011, underperformance rife amongst active fund managers. This was 6 years before Eugene Fama got the Nobel Prize in economics for proving this. All right. So if you keep doing it, you're getting punched in the face. And please don't ask me, oh, so which is a good IFA? There isn't one. They're conflicted, institutionally conflicted, because they can't ever tell you to hold cash. And they never will, because they won't get fees if they did that. And the fund managers are not allowed to hold cash more than 3 or 4% in a fund. The rest has to be invested according to their mandate, because they can't charge you money for holding cash, because a bank has to pay you money for holding cash. They're not going to be allowed to charge you for holding cash. It'd be a con. Okay. So that is why, right? Now, so now you're afraid because you're thinking, I can't do it myself. Yes, you can. I know most of you think it'd be like this. It's not. It's actually a hell of a lot easier. I can teach you in a bloody hour, for God's sake. You need 1, all the data. Obviously, you need data. 2, you need know-how. Data and know-how. If you don't have data, then knowledge is useless. If you don't have knowledge, then data is useless. Okay? And we just want to make all these green. If I press that filtered there, that button, dare me, it will show you the list from which I would select. From 10,000 stocks, it goes down to 200. Okay? And for my clients, narrow it down even more. But you do it. I don't manage your money. You manage your own. The whole point of all of this is, so if you want somebody to manage it and you're looking for a better IFA, please leave now. I'm not going to manage your money. I'm not an IFA. Don't want to be. The conflict of interest would just make me like all the rest of them. No, that's it. It's this, and you want it to be all green. Because otherwise you're ignoring value, growth, income. And guess what? That's not a journalist. You can't just go pick up a magazine and say, well, the journalist said this, I think it would be all right. You know, what do they do for a living? Well, they're a journalist, for God's sake. Now, you might then narrow it down as we do with which hedge funds like this have got billions and generating 52%. And do they have any of our filtered ones? We might then narrow it down and say, oh, well, yeah, this one generates 52% a year, and they also have one that we've got. Okay, then that's fine to narrow it down as a tiebreaker. And by the way, if you take the S&P 500 and the most number of guru holdings, United Health Group, I own, Alphabet, Amazon, Apple, Microsoft, I own. I don't have Citibank. Meta, I'm going to tell you later on the private channel. JP Morgan, I continue having as well. Adobe did have, but don't anymore. PayPal have, okay, and there's a whole bunch of others, right, on there. Oh, look, you can see Netflix on there, which I don't have, but I know it's gone up 100% in the past year, but it's one we've been covering just to show you. Just to show you, look, I'm so good. I can even give you ones away for free, which go up 100%. Analyst projections. We might use what the biggest wealth management banks, like Scotiabank, are saying, and generating 40% plus per year. What do they hold? Are any of these in our filtered list? If they are, then we can use it as a tiebreak. Say, look, it's on our filtered list, completely filtered, all greens, and these guys own it as well. That's what we do. Like I said, we might use, again, hedge fund projections, as we've done there. And are any of these on our filtered? Don't just buy these. It has to be on our filtered list. If it isn't, the fact that they own it is irrelevant. I'm just using the hedge fund managers and the wealth management banks as a tiebreaker. Once I've gone from 10,000 to 200 stocks, I still need to reduce it to 20. So that can be a good tiebreaker. That allows me, by having this, to scan US, UK, global ETFs really fast. By the way, who do you think is going to win the general election in America? Let's have a look. Okay, I'm going to show you. You think 56% of you think Trump, 43% think Kamala. Okay, 56% think Trump. You may well be right. I've just come back from New York. Yeah, I think you're right. I'm going to call the election for Trump. Okay. I'm also going to post another poll before I make the book available. So if you want the book, go to alpeshpatel.com/shares. And on the webinar, if you sign in, you'll be able to get a copy of Investing Unplugged as well. Okay. It's on there. All right, so those files are on there, and let me know if you can't find the book on there. It's the files are on there. I'm going back to the poll and asking people on the poll, what do you hate about IFAs and pension funds the most? Now, why I do that, this is what I do. That's it. That's it. You know, I was asked today, somebody in government, are you incredibly busy? And I was a bit embarrassed to say, well, no, because by the age of 53, I pretty much worked out that that is my holy grail, and that's the work done. It does make me feel a bit guilty. More than $1 trillion of Muppet money costing service billions. Because people don't know what to do, there's $1 trillion of cash sitting in ISAs. Now, what I want to do is educate them so that across the world, and that's just the UK, there's trillions sitting uninvested in ISAs, savings accounts, current accounts. I want to educate them so that 1 million of them, through webinars, free webinars like this, so 1 million of them around the world, add an extra $1 million in performance to their pensions across their lifetimes, not in a minute, It's not get rich quick. So that's $1 trillion in added value across the world. That's it. And then I die. And on my, well, I'll be cremated, but somewhere it'll say on the urn, yeah, I did something useful. To invest and save. That's what it'll say. To invest and serve. To invest, save, and serve. Right. Why? Well, it's actually pretty easy to beat these Muppets. Look. These are relative performance to the benchmarks they have now. I'm going to let you into another secret. I know the boards of these kinds of funds. Okay, not the specific boards of these funds. And on those boards, one thing that you realize is that the fund managers will pick a benchmark, and then what they'll say is, right, the benchmark has XYZ stock in it. We think we should buy a bit more than the benchmark and we'll outperform the benchmark. That's all they do. They don't say which are the best companies. They say the benchmark has ABC Inc. We want more of that. We want less of XYZ Inc. That's it. They just play around with the benchmark holdings and they're trying to beat it. And then they bugger off home. And they're usually in their 20s because you pay less money for somebody in their 20s. Okay, relative performance. That's their relative performance to the benchmark. I mean, come on. Honestly. I could teach my secretary to be a fund manager and manage billions. In fact, I have. I'll introduce you to her in a second on the webinar. And she manages billions. Biggest mistakes I've observed amongst investors that I'm going to show you now. Mistake number one, not doing quick and proper analysis. This is the worst. Okay, they think that they can get away with just not looking at valuation or growth or dividend deals or momentum. You cannot invest without information. If you don't have information, data like this, then you're gambling. Of course you are. Throwing darts at a dartboard. All right, it's as simple as that. I'm sorry, it's as simple as that. I've written about it in my books. I've told people time and time and time again. Okay, mistake number two, not knowing when to hold and when to sell. 12 months. Now, what happens then is your holding period, if it drops 25% from entry, get out. The bigger problem then is, well, but Alpesh, I don't know when to exit. I just told you 12 months or 25% drop. Yeah, but I exited prematurely on a baby bear. That's a baby bear where the market falls, but the short and medium term prices are not falling, as shown by that. Then you ignore the falls. Mama bear, where the price falls a lot and the short and medium term prices are falling. However, you can still ignore those unless it's one of these, which is the daddy bear, where it's overbought, i.e. in the top part of the graph, and it's fallen below its own moving average. Okay? That's a daddy bear. It's simple. I've put this in as a concept to the Nobel Prize Committee, the Nobel Prize in Economics. I think this deserves it. I'm sorry, I think it does. Because I think it's bloody ingenious. There you go. Okay? Tongue-in-cheek slightly. So those of you taking that seriously and now calling me names. But that's it. That's what we want. Look at it. Okay? 3, 2, 1. And that's your Goldilocks investment. Right? Where does this get you? Well, in a bad year like 2022, you get a 0% return. That was it. Typical stocks on filtered list. So what would the typical stocks generate? 54% in 12 months. In an amazing market like 2020, 2021. The market was amazing. That's why we did so much better, because we had alpha stocks. Alpha stocks are the ones which outperform the market anyway. But we had high Sortino. We had value, growth, income, cash flow, Sortino. Okay, so why didn't I put all my money in Crocs and just get a 208% return? Because I didn't know which ones are going to do incredibly well, or Generac, or Costamer, or Cam. I didn't know which one of these would do well, and some of them didn't. That's why it's only 54%. We had Crocs at 208, so why is it only 54? Because we had some which would have lost money. So the average was 54 because the market did well and because we didn't put all the money on just one company. Mistake number 4, not having an exit plan. When to sell, 12 months, 25%. Simple. As a fund manager, looking for stock picks, right? You look at too few stocks. You say, oh, I'm only going to pick UK ones. I'm only going to pick emerging markets. Well, if you do that, you're bloody asking for trouble. So we ask people, why are you fed up with your IFA? 1, underperformance. 66% of you said underperformance. Not trustworthy, 16%. Lack of information education, 16%. I totally agree on all of those points with you. It is shocking. It is obscene. It is really telling that they do that. Won't you give some breadcrumbs to the people? I just gave low. October, pretty pleased. Alejandro, I just gave loads. I just put loads up on the screen of which ones fit, which ones don't. I've also told you which ones don't as well. Okay, from the filtered list, and what I currently own and what I buy more of. I'll do some more, Alejandro, in a second. If you feel like I haven't, I'll do some more. Okay, I'm looking at some right now on screen, so I'll do some more. Okay. They look at too few, or of course they're paying more than they realize to fund managers. This is from an actual fund manager. £10,000 investment after 5 years, recommended holding period. Of course it is. Get £1,000 in fees. Fees, total cost, 10%. People don't realize it's 10%. They think it's less. It's not. And that's why I get comments like this about Legal and General. 20% in 10 years from Legal and General, whereas they followed my weekly reports and they got 20% in a year. There's a big difference. So I said with a lot of these, I was looking at 40% projections. Is that realistic? Well, only if Sortino, Alpha, they tick all the green boxes. Only if all of those, and you have the 25% stop loss, and you've got Croaky, you're ticking all the greens. And the market goes up. If it's 2022, then no, you're not going to get it. So what would happen? This is what would happen. And even that last year, the 80%, that'll never happen again. Alpesh, why not? Well, it's better for me to assume that than we're going to get this every year. I've got that every year. Bloody hell. I'd own an airline. But look, even then, with the same approach, you got minus 1.6. Somebody once said, yeah, but if you take out all your good performers, you didn't do so well. I said, yeah, you're right. If you were to take out all of these, if you just said I picked Tapestry, which I didn't, which is why you don't ever pick one stock. Now, which do I still own of these? Now, I don't think I currently got Service Now at the moment, but it's one which I showed you earlier and I wouldn't mind holding, Alejandro. Amazon I currently hold, as you will know. Nvidia I currently hold. JP Morgan I currently hold. Apple I currently hold. Microsoft I currently hold. Alphabet currently hold. Okay, so these have continued from last year. Thank God their returns have as well. Oh, by the way, I should say with Apple, Microsoft, Alphabet, Amazon, they're in my son and my wife's SIP and ISAs, and they're 2 times leveraged on those. Okay, just so you know. But that's not the leverage performance you're seeing there. That's unleveraged. Leverage is risky. Don't do it. But they're 2. I don't do more than 2 times on investments. So that happened. No, well, they're names I've heard of. Yeah. So what? What can I do if they're names you've heard of? I hadn't heard of Sterling Infrastructure. I hadn't heard. Well, Service Now I'd heard of. They're even starting to advertise now. By the way, they met the Prime Minister in a couple of weeks ago. They're really aggressively expanding now. They're pretty much on the AI cloud interface. They're going to be a big winner in the world going forward. Famous last words. That's an exception. That's not going to happen. That makes up for 2022, which was 0% because we had to hold cash most of the year. I don't even know what MedPace do to this date. Now, let's say you plan to invest over 10 years, and let's say you make 20% per annum. Some years worse, some years better. Okay, and it will be erratic because the markets are erratic. So you got 100K, and there's no guarantees either. You plan to add 1.5K, you should get to $1 million over 10 years. 10 years, 1 million from 100K. That's your job, to convert 100 into 1 million over 10 years. Now, if you're a serious person, you want to plan ahead, and 10 years from now, you'll thank yourself you started this 10 years ago, right? Because in 10 years, you would be getting 100 grand a year just from passive income. Great, that's what you want. Yes, I know it's called what that's called. And compounding is, yes, I know, wonder of the world, blah, blah, blah. You know why people don't do it? You know why they never do it? Because the first 2 years, there's nothing to show for it. A bit like weight loss programs and fasting. You only see the results after a very long period of time. So what's the bloody point? Okay. What this shows is if you are looking at ways of improving your retirement, you could start sooner. Well, you haven't got a time machine, so you can kick that out of the way. You could save more. Well, that's a pain in the ass because that impacts your cost of living, quality of life. Or you could improve performance by a little bit. Guess what's easiest? Slightly improving your performance through your knowledge and having the data. Why do I think you can be better than overpaid fund managers like this Muppet? And You know, you've heard of the Wolf of Wall Street. Meet the Cat of Wall Street. The cat did pretty much as well as this fund manager who ran billions. Billions he ran. Billions. The cat, in a competition to pick random numbers, did pretty much as well as the fund manager, the Cat of Wall Street. He's the Muppet of Wall Street, right? 20 stocks on the whole is what I'm looking at. 20 stocks on the whole is what I'm looking at. I'm not sponsored or endorsing Barclays. I'm just saying that was me. And the book that's on the files, you should all be able to see. I'm going to stop sharing the book. So if you've not downloaded it, you should have done. Okay, because I'm going to stop sharing that file. It's on alpeshpatel.com /latest. Still got a bit more to go. So that's who I am. All of those books I've written about this. I've written about the Nobel Prize with my publishers, the Financial Times, amongst others. Croaky is probably one of the most important formula. Actually, if you said to me which is the most important, I would say the most important for me is my value growth income score. Valuation is more important than growth, is more important than income. And then I'd probably say Croaky. You can't say, well, that's fine. We'll skip your value growth. We'll just look for Croaky. Why is Croaky important? Well, Goldman Sachs Wealth Management Research Division did some research which I stole, okay, which is this, right? It's from their quantum database. And what they discovered is companies in the top 25% by cash return on capital invested generate 30% per annum returns. Not every company in the basket, not every year, like the financial crisis, nobody did. So I want to tick that box. That's all I'm saying. I just want to tick that box. I'm not saying it's guaranteed to. I'm not saying it's going to work every year. What I'm saying is, shit, if I've got that research in front of me from their quantum database team, sounds sexy, Goldman Sachs Global Investment Research, well, I better not bloody ignore it, had I? Because I'll feel stupid if then the stock drops. Okay? So we're sort of almost reducing regret in a way. So that's the first thing. Second thing, this is a typical bad portfolio I'm sent by people. Their IFA wealth managers shoved them in tons and tons of funds. Each one of those funds will have about 100 stocks in it. So they've got about 1,000 stocks. They've got some bonds. That's fine. Don't have an issue with that. The stocks, they've got about 1,000 stocks, and then they've picked some of their own based on name recognition in the UK, and they're performing like shit. All right, so their pension's basically screwed. They're going to have to stay with that wealth manager for a prolonged period of time because they're never going to have made a decent return. God forbid they do make a decent return, in which case they'd leave the wealth manager, and the wealth managers would be in trouble. So that conflict of interest is going to stick. Or take this person who emailed me at the back end of last year and said, oh, great, Bruin bloody dolphin. Stock spread over 1,000 different companies, scattergun. They spray and pray because it's a marketing effort. What they're trying to do is have some good news to give you each time they have their calls, if they have them at all with you. And how do they give you that good news? Oh, really simple. What we will do is we'll spray and pray lots of investments. Surely one or two of them might have gone up. So I'm going to show you something now. We're going to get into the last 10 minutes. I'm going to show you something, as I've already shown you actually, that I use. I'm going to show you how to get your hands on it. Because it's important. If you want to learn all of this, it's for free. It's on campaignforamillion.com. Okay, learn it. The data, this data is mine, it's proprietary, but you can learn why you shouldn't be doing what you're doing at the moment. And that in itself will hopefully save you lots and lots of bloody money. I met Kanira this week. These are 4 women who worked for me. I don't just hire, actually, I didn't hire any of these. My team hired them and then they were working for me. Naomi was my secretary after school. She worked for me for 2 years. Every time she launches a new fund, she will reference that she worked for my company in her filings with the regulator, and she now doesn't work at Newton. She works at Polar Capital and manages billions. I can teach a secretary to be a fund manager. She joined me from university, worked for me for 2 years, and then went straight to Newton. I'm going to take a bit of credit. Behind every great woman, there is a man taking credit. Kirsty now works in pensions law. Susan is head of international communications for Wells Fargo. They're all talented in their own right. And I met Kanira just this past week, who is ex-Imperial College. Very clever. Okay, but you don't have to be very clever to be in investments or pensions or whatever. And people say, can you manage it for me. No, I'm not going to manage it for you. I want you to manage your own money in your own brokerage account with whether it's a Barclays or a Hargreaves Lansdown or Interactive Brokers or Interactive Investors, whatever else it is. I want you to get the data and apply the knowledge. And you can learn all that in just 1 hour. It's that bloody simple. Okay? It's that simple. The ideal should be you can do it at your own pace, in your own convenience, no hotel costs, broker independent, and have somebody to speak to, me, for the rest of your life. I've done a load of videos on YouTube on this as well, by the way. I'm going to show you how to get the data in a second. 1.5 million views was achieved October 17th, 2024. It's not bad, is it? Lots of, right, that's a hedge fund manager. That's Merrill Lynch. That's American Express. That's Winterflood Securities. That's BBC. That's Financial Times. That's Coutts Wealth Management. All of these people were sort of endorsing my approach, all the stuff that I've written about, saying, this is how you do it. This is how you do it. Because every single one of them endorsed the approach written down in the jacket covers of my books. Okay. And that told me, bloody hell, we're onto something here. If Coutts is saying it, Financial Times, BBC, okay, Bloomberg. So we gave this to a bunch of people, and then we thought, right, we better video interview them because nobody's going to believe the wonderful things they're saying. And we created a website for it, alpeshpatelreviews.com, alpeshpatelreviews.com. If you want to get the data and you want me to handhold you, as opposed to you teaching yourself, which you're more than welcome to do, that's what we're doing. The reason I launched this was I said, well, look, in the hedge fund, I launched my first fund in 2004, an equity long-short fund. I said, in the hedge fund, we can only have institutions because that's the law. You can only have family offices, pension funds to invest into your fund. But what about the retail client who I'm been writing about and writing for years? What about the retail client that I made my Bloomberg TV shows for? What about them? So why not give them free education this way? But also for the 1% who want more than free education, want the data and have access to me, why not give them something more and turn asset management on its head? Then it became huge. And I realized we could make this into a floated company. We could get venture capital into this and we could make it huge. And so I started taking on people in batches of 10 to join. And I said in the webinar, if they join, I'll give them signed copies of my 2 most recent books. They can keep that forever and a few other goodies. And the idea was, once I get to 350 people, get venture capital investment. Originally, I was going to get to 250 and do it. I thought, well, actually, we've got even more evidence when you've got 350 happy people. Okay. And that's what I want to do. Build up that body and then get venture capital investment and then float the company as an alternative asset manager in the future. An asset manager where we're not managing your money. You're doing it, but you've got the data and the access to the expertise through me for the first 350, for other people in the future after that. So anybody wanting to be part of it at the moment would get me for life as the person teaching them through this and through, we have a ton of online material. People say, what happens if you fall under a bus? We're a company. We've got data providers. We've got other people who can show you exactly what I teach you, but also everything that I teach you, I've put online as well. So you just have to not be able to have the one-to-one calls with me, but you wouldn't need those. You wouldn't need those because after you've learned to drive, you don't need to speak to the driving instructor. You'd continue getting the data forever. So we made it really simple and really easy. And then we thought, well, what should it be? And I said, well, I don't want to charge people an annual fee. I don't want to. I don't want to keep doing what the conflict of interest of IFAs and wealth managers. I don't want to charge them 10%, 20%, some kind of annual fee. No, that's not fair. And these are the 2 things people wanted more than anything. They wanted the data and the access to me. Data and access to me. And if I fell under a bus, they'd still have access to me because they'd have all the videos, which teaches them anyway. And the data still gets provided because it's a company. Okay. And so would the education because everybody else knows exactly what I say and the way to do it. Simple. Okay. So we thought, well, how do we price it? How do you work this out? I mean, if somebody gets a 10% improvement on a 100K portfolio, well, that's 10K. So, and I don't want to charge a subscription or a percentage. So what should we do? They make 100K if they get a 20% return on 500. So it became a no-brainer for people with 500 or 250 in their portfolios. Because I've got $250,000. Even if just 1 year, this guy gets me a 10% or 20% return, I make my returns back. And it's not me even doing it. It's me giving the data and the market doing it. So it became ingenious. It became a no-brainer for people to do. So I said to my team, make me a page which gives a call to action. And they came up with the most garish page you can imagine, which was this. But they said to me, they assured me, they said, no, you've got to make it really clear what people have got to do. So if you do want to be part of it, and I said, my ambition is to float this as an alternative asset management company. I want to drive St. James's Place to the wall because I think they've got a massive conflict of interest. I think they've got 900,000 miserable clients. No, they've got 2 clients who are happy. They've got 2 clients who are happy. Okay, they've got 899,998 unhappy clients. All right, and the 2 clients who are happy are both hospitalized in the dementia ward, sadly. So there you go. That's it. That's what annoys me the most about them. I'm joking, of course, before somebody decides from St. James's Place to litigate. The level of complaints they have, they're used to it. Their latest marketing campaign is don't go for the pedigree, good quality funds, which we don't have. Go for the shit ones, which we've got, because surely at some point they'll do better. That's their latest marketing campaign. You can't make this up. You really can't make this shit up. Okay. If you would like to join me on the program, you're welcome. I'm going to answer a few questions and I'm happy to do so. I love this stuff, which is why I do it. Alpesh, what are your thoughts on Disney? Disney, like many of the others, have still got no issues. I can't follow everything that I've got all the time. But yeah, I've still got it. And it'll come on tonight's broadcast, weekly stock market update for my clients. Anyway, so yeah, there's loads that come up every single week, and I don't keep on. I'll give you another example of one. Somebody said to me, what do you think of Trimble? Because you used to look at it. And I say, yeah, it's still holding it. And it's at multi-highs. There was another as well like that. Trend Spider. Sorry, I'm trying to go to trendspider.com. Here we go. And I'm going to show you something else on some of the ones that I've not covered recently. This is the process. That's what makes us different. It's as simple as that. That's what makes us different. On there, right? And I'll just show you Trimble. Here we go. So what typically happens is you get something like this, okay, where something falls, and this is why it's 12 months and not longer. So let's say you get in here and you think to yourself, hey, I'm doing really well. I'm so clever. We're up 46%. And then what happens is all of those gains go. You have multiple months where you're down significant. So you're down, Alpesh, pretty much half my gains have gone. And I say, yeah, 12 months. That's what the holding period is. And then, of course, it recovers and you never hear from anybody again. They go, oh, wait a minute, that's the highest it's been. This is amazing. And so what we say, and I want you to watch this, look at previous drawdowns, i.e. falls, peak to trough falls, and the duration to recover, and assume it's going to happen again. If you can't handle that volatility, don't do it. The reason for that is this. Sometimes people think that if you mention something, if it comes from Alpesh's lips, it's only going to go in a straight line. Never in the history of stocks has that ever happened, with the exception of there are occasionally, I want to show you another one, Novo Nordisk, which I don't have at the moment, but it might be one which we get later. Sorry, not, well, there's that, but let's take Eli Lilly, which we've had in the past on and off. I don't have it at the moment, but we will in the future for sure. Wish I still did, but can't own everything. Ideally, you want stocks which look similar to this. Shallow drawdowns, quick recoveries. There are very few of those. So that doesn't mean if you take more risk with more volatile stocks, you're suddenly going to get better returns. Okay, that's not what it means. Okay, Keith, I'd probably say roughly another 70 to get to 350. We're about 280-ish, roughly. I base it on not the round number as such as capacity, and I've got capacity. I thought when I'd have 250, I wouldn't have capacity to handle more. But actually, as people have learned to drive, consider me a driving instructor. It's all been fine. So if you look at, say, an Eli Lilly, the ideal stock I want is going to look a bit more like this. Or let's take a Microsoft. Now, if you're looking for that kind of move, ignore 2022 for a second, because that was a daddy bear. So you could ignore that, because if you get a daddy bear, you're not in it anyway. But if you look at most years, and this won't always be the case for a Microsoft. There'll be years when this just doesn't happen. It could be any company. But if you can have shallow falls and steep recoveries, shallow falls, i.e. high Sortino, high alpha, and high value growth income, great. But there are too few of these, which is why we don't just have the 8 stocks in the world which look like this, the quality 5+, basically, because 8 would be too few. It'd be too concentrated. I'd have to be like Bill Gates, a billionaire, before I just did 8, because actually most of his money's in his first 8. And same with Warren Buffett, but I'm not a billionaire, so I have 20. So what then happens is I'll have more volatile ones. Not because I want them, not because volatility means greater returns. I'll have more volatile ones because that's all that's left. And that's what people don't get. They think, oh, you pick volatility because more risk means more return. No, look at Microsoft. Less risk means more return, but there's so few of them. Okay? And so that's why you end up with some which are not as tight as those, because humans haven't invented the companies. But you can't just have 8. So you've got to catch 22. The best ones that I want, there's too few of them. The ones which aren't best, we've still done all the research. And even with Microsoft, not guaranteed to go up, and either, of course. Stride SLRN went up 35% today. Amazing, isn't it? I didn't even know that. That's amazing that in one day something can go up so much. And there's a double-edged sword also with name recognition. Sometimes you give name recognition, people think, well, I know that, I don't want it. Other times they think, oh, I know that, I really want it. Name recognition doesn't guarantee better returns. What it does is, for me, I know it's a Microsoft, or there's name recognition or whatever else. It just gives me a degree of extra psychological comfort. I know it's psychological, so it's less important. But what do you want me to do? If I said to you, I don't want to give you that, I'll give you, I don't know, R1 RCM, you go, who the hell are they? Well, thankfully, I wouldn't give them because they don't tick all the boxes. Now, that's not to say the ones that don't tick the boxes can't go up. They can. You might get Elon Musk doing a sort of a tweet, and all of a sudden it shoots up. Fantastic. That's perfectly fine as well. What other questions have I got on that? Don't forget you can download the book as well. Some of you put some message on the Q&A. Sorry, I didn't see the private messages on the Q&A only. Yes, I will show you. So were I to fall under a bus, you need not worry. It's a company which continues providing the data, but also, as I said, all the education material as a backup. My brain is on here. So most people don't read and do the education. They do the one-to-one tutorials. We did one-to-one tutorials. I stolen the best ideas from billionaires and the best institutions. So to give you an example, you're basically my apprentice. Well, I stole that from Alan Sugar and Donald Trump, who run The Apprentice. The one-to-one tutorials I stole from Oxford University because they get good results, and one-to-one tutorials is a bloody good way of doing it as well. And I think it makes a difference. Tomorrow I've got an event in Parliament. I'm hosting 200 business owners. 200 professionals for a business event. If you'd like to come along, do come along. And also when you go to alpeshpatel.com/shares2, you do get to meet me, but you could also do installments if you wish, was the point we're making. Now, I'm afraid the cost of this is going up again. And the reason it's going up, it's a bit like cryptocurrency. As there's fewer spaces in circulation, the price goes up, supply and demand. Okay, so the price is going to go up imminently. Whoever's on it at the moment would always have me for life, but that won't always be the case for those. Oh, we've got to update that part because I said first 250. I need to update that to 3 now because I've increased it to 3. Like I said, my overall ambition is to float the whole asset management company. Not just invest in other people's listed companies, but have the listed company of my own on there. So yeah, that's that. For everybody who signed up, sorry, yes, there's a couple of messages that have come through. You will get an onboarding email from me straight after this email. So do wait, straight after this webinar. So do hang on and check your inbox tonight. You will get that. Thank you, Peter, Jason, Scott, Robert, Hugh, Dave, Alex. Thank you all very much. I'm going to, if there's no other questions, I'm going to say to all of you, I will continue all my free stuff, of course. Do watch campaignforamillion.com. I am committed to providing all the free content to you all as well. And that will continue. In the same way, I will make sure I give copies of my book for free, or one of my 18 books for free. And it's not a small book either. It's about how on Bloomberg TV, we selected companies. It's everything that I've taught you here as well. That's on there. The website, yes, it's that one. So thank you all very much. I'm going to say goodbye to TikTok as well at this point. Thank you all for everyone who's been on there. So do send your love hearts and diamonds and thank yous and everything else that people do on TikTok. Have a look at alpeshpatel.com/links. So thank you, the TikTokers, on my first ever live TikTok on my new iPhone, which is rather good. I found the battery life is phenomenal. It's incredible on the new iPhone. Everyone's whinging the iPhone's not innovative enough. Every single product Apple has ever produced, people have said it's not innovative enough. That's why they sit in the cheap seats on that. Okay, people, I'm going to go. I think I've answered all the questions. Thank you all very much. Oh, what's better for the S&P? I think Trump. The data would suggest it's Trump. He'll be more reflationary. If you look, Deepak, at my, I don't know if you're, Deepak, your name doesn't ring a bell for the private Telegram channel, which is for the clients. I did do a posting about how Trump would be more reflationary. I might have put it on the general Telegram. If you don't know where the Telegram is, alpeshpatel.com/links. Okay, alpeshpatel.com/links. Okay, thank you very much. I appreciate all the people who signed up to the program. I will send you an email after this webinar and look forward to improving your pension. Whilst we can't guarantee the markets will go up and do that, bloody hell, we don't half have a good record at being able to do it, which I'm really pleased about and proud of my life's work. Thank you very much, everybody. And Joseph and everybody on the program, thank you as well. Cipriani's was great, wasn't it? Joseph, I've got to share the video and everything yet. I've not even had a chance since I got back, but I will do all of that. Thank you all very much indeed. I'm going to stop sharing the screen. Thanks for being on the webinar. I hope you enjoyed it. I hope it was useful. And any questions, just email me, send a message in. Cheerio, everyone.